ed program put on by the American Association of International Certified Professional Accountants, which is a mix of the AICPA and the CIMA. And once you're an accountant, you have to continue your education. You have to have 40 hours of continuing ed a year. So this is taken from one of the continuing ed programs, and it's been edited for brevity, but the intent is to give you an overview. To do that, though, we need to understand that there are two types of corporations. What we call a C corporation, and that's a traditional corporation, and taxes are applied at the corporate level. Okay? So the corporation itself is taxed. It has a continuity of life, it doesn't end, centralization of management, free transferability of shares, and limited liability for the shareholders. The hitch is double taxation, because it's taxed at the corporate level, and when a company passes out dividends or buys back shares from shareholders, that creates a taxable income for the shareholder. Okay? So that's the big thing, is the potential double taxation that's there. But there's all these benefits that come into place here too. For smaller corporations, we have what's called S corporations, subchapter S. In these, the income is taxed at the individual level, and it avoids double taxation. You can elect it. The corporate issues are the same. There's no difference from a liability percent transfers. However, S corporations are based on the number of shareholders. So with publicly held companies, you can't do that. The corporate issues are the same. It avoids double taxation, but what happens is the corporate rate is lower than the personal rate. So the tax code adjusts that to some degree. And here's an example of a pass-through, simple pass-through, taxable income of $315,000, married filing jointly. On a pass-through, the way they fixed it is there's 100 business income, and you take the special business deduction, 20%. There's rules for that, of course. That's taxable income. Tax rate is 24. So 100 of income, 1920. Net to the business owner is 8080, and that's taxed. The effective tax rate is 19.2. So they've come up with this special deduction for subchapter S, the pass-through entity. Then in the C Corp, this is how it would work, be 100 times 21%, okay? And that's the corporate rate, would give you 79, and the shareholder income tax at 18.8, assuming taxable income, and that would be a tax of 14.85, net to the shareholders of 64.15, or a tax rate of 35.85. So if you're for tax planning, if you're a small enough company with limited number of shareholders, you're better off being an S corp, taking the special business deduction, get the lowest tax rate. However, you have this situation here with the C corp, that the tax rate is a little bit more. So that's the potential. Now, if a company doesn't distribute any dividends, it's irrelevant, okay? Because the shareholder is looking for either an increase in value of the underlying holdings or dividends. But this can be a negative that is there. The current tax rate for 2018 going forward is 21%. It's a flat rate. It used to be 15, 25, 34, 35. So the folks that benefit the most from this are big companies. If you have more than $10 million of income, your taxes went from 35 to 21. This was intended to be behavioral. Okay, we want you to go out and spend the money to make an investment in the company. Unfortunately, what we have seen is most of the tax savings has gone into dividends, buyback of stock, reduction of debt, executive compensation. So it has not had the impact that was desired. And you ask, well, why didn't it have that? Well, companies still have to deal with the supply-demand issue, okay? But if they have a shortage of workers, it doesn't make any sense to add more equipment when you don't have enough qualified workers to do what you're going to do. We get into some details here. It's called cost recovery, is also known as depreciation. And they have a bonus depreciation. And again, this is intended to incent people to invest. Between 2017, 22, up to the limit, you can deduct 100% of the cost of that equipment that you may buy. So that is giving you a huge timing difference. Previously, it was only allowed to new property, and it was expanded to include used property. But again, influence companies to make more investments, spurring economic growth, increase productivity, and efficiencies nationwide. We haven't seen that. As you go back to our original discussion on the macro environment, and what we see is that the consumer spending is still driving the economy. So the impact did not happen as intended. On this cost recovery, currently you can deduct $500,000 of property, and now it goes up. The phase out goes to $250,000, and the limit goes to $1 million. So again, this benefits sometimes the smaller companies the most who make those investments, although every corporation can benefit from the first $1 million. Expands the definition of tangible personal property. It used to exclude furniture, lodging, or connection. That's now eligible. They also said you can now look at non-residential real property, commercial property, and you can deduct roofs, heating, ventilating, and air conditioning, fire protection, and security systems. Previously, that wasn't included. So they're trying to drive investment by business. The next thing they did is, and this is, some of this was policy, some of it was thoughtful, some of it was just stuff bolted on to make people feel better, some of it was political. And in this case, it was. Businesses with average gross receipts, revenue, do not exceed $25 million are exempt. Okay? The proposal that is there and what is coming into place, that if your gross receipts are more than $25 million, they disallow interest expense in excess of 30% of a business's adjusted taxable income. And the adjusted taxable income is before depreciation, amortization, or depletion. And so that's limiting the amount of the interest deduction. And if you disallow it, it could be carried forward. It's determined at the tax filer level, not the individual. At the taxpayer's election, certain real property and construction businesses and farms are exempt. Okay. So this gets in, it's intended to penalize those companies that have excessive amounts of interest or leverage. So that was there. The net operating loss deduction. Under current law, you can carry them back forward 20 years and back 2. This time the legislature said, no, let's limit that to 80% of taxable income. Attempt to minimize the use and offset some of the benefits given to others. It would eliminate carrybacks. In the past, you could carry it back 2 years, and if you could carry it back, you'd get a tax refund. They said, no, we're not going to do that anymore because that would cost cash. So now you can only carry them forward, and instead of 20 years, indefinitely. So you get to use it, but that's it. This may be, as we talked about, this might be a reason to do a merger, is that you have a company who has a net operating loss deduction, And you can structure that you could reduce your taxable income. That's tax planning. Some small nits and gnats in there. Some of this you may come into when you join the workforce. You might find that under the new rule, old rules, you might have gotten something. And again, how companies handle this is from your, and let's take meals provided for convenience of employers. You're going to travel. You're going to work late. Previously 100% deductible, assuming they're not included in your gross income. Now it's only going to be 50% deductible for the company. So the company is going to have to pay a tax on that, and it's not a difference. Here at this point, everything is taxed. This one is I don't know who put this one in, but under prior law, there's, and the new law, essentially what there is for a certain highly compensated individual, there's limits of what's deductible for tax purposes. Okay, and under prior law, it was the top 5 or 4, depending on which law, highest, the CEO and the 4 highest paid, and then it went CEO, 3 highest paid, excluding the CFO. 2018 going forward, all CEOs, all CFOs, the 3 highest paid, and all executives defined as covered for any year beginning after. So you don't go away. Once covered, always covered. So there's no limit. Maximum deduction would be $1 million plus qualified performance. New law, just $1 million. Shareholder voting requirements, pre-approve them. Under old law, new law, not applicable. Performance-based, not applicable. They're not deductible anymore. They then introduced what's called the territorial tax system. The previous tax rate in the U.S. Was 35%. That was the highest in the world. Under the old system, a company doing business in the UK, a U.S. company doing business in the UK, would pay the UK tax rate of 19%, and then when its profits were sent back in cash, repatriated, there'd be an additional tax, 35 minus 19, so you'd have to pay in 16% additional tax. The goal was for companies incorporated and having headquarters in the U.S. pay a tax of 35% no matter where the income was earned. Now, over the years, many companies moved their headquarters to low tax jurisdictions. For example, Ireland, and didn't pay U.S. taxes on non-U.S. earnings. Now remember, we're in a global environment. Where's the market? It's all over. The Tax Cut and Jobs Act addressed this by creating a territorial tax system. And what that is saying is that U.S. multinationals will no longer face an additional domestic tax when they remit the profits in cash back to the U.S. Okay, so that's a huge, huge difference. And the intent is to try to bring more funds back to the U.S. for investment. So we still have the 100% deduction. But, no, there's always buts. When somebody said, whoa, if they can bring all this money back and not pay the tax, that doesn't seem quite fair. So what they did is they put in corporations to repatriate and pay a reduced rate on those deferred earnings. So they have 8 years to pay it, paying at least 12.5% a year. If it's held in cash, it's a 12% rate. Reinvested earnings are subject to a 5% rate. So yes, they reduced it, but they're still trying to tax that historical income that had not yet been repatriated back to the U.S. They did impose a tax on certain foreign income. They did discourage income shifting by subjecting income to current U.S. tax. And And it gets into a lot of other things that we don't need to do that at this point. You can look at it. It's called GILTI, Global Intangible Low Taxed Income. You should just be aware that there's weird things there. We're going to skip that. Impact of tax reform on foreign corporations. Full dividend received deduction. One-time tax on unrepatriated earnings capped at the top rate. The global intangible. Incentives for foreign intangible income. And it's imposed on domestic corporations operating internationally. This has been a huge benefit to American corporations. Okay, it will generate significant corporate profits over the future. The implementation is very complicated. Remember, it was policy, the intent to create investment, which when we go back to our macro, we haven't seen that happen. So where's all the money going? Corporations are accumulating cash. They've bought back stock. They've paid dividends. They've reduced debt. Have there been acquisitions and improvements? Yes. Has that been the majority? No. At the same time, there was it did impact personal taxes, but 95% of the benefit went to America's corporations. And when you look at dividends and stock buybacks, that eliminates, again, a significant portion of the population from that benefit. So that gives you a sense. We want to always look at and understand the tax implications and why. Don't re-engineer stuff. A lot of this is in the 10K, and it's about interpretation. If you have any questions, please let me know.